We are back with Ed Devlin, founder of Devlin Capital and a senior fellow at C.D. Howe Institute, Warren Lovely, chief rate strategist at National Bank of Canada, and Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Okay, let's keep it going here, gentlemen. We'll start with you again here, Earl. We got an email from a viewer who is wondering about mortgage rates and what this cut and what potential future cuts could mean.
Yeah, we'll look at it from two perspectives, variable rates and fixed rates. So anytime a Bank of Canada cuts, it has a direct impact on variable rate in regards to the flexible rate or that moves overnight. So we'll continue to see that going lower as the Bank of Canada continues to ease. The longer term rates, let's say the 5-year rate, is, I would say, as much influenced by the U.S. and U.S. 5-year rates as it is Canada. So that will go down at a slower pace. Having said that, one thing we didn't talk about today, and you see this with market participants, we just focus on the headline in front of us. But I believe this year is going to be a tale of two halves in regards to a possible slowing, not a recession, but a slowing in the second half. If you get that slowing in the second half, that bodes for lower long-term rates, and I think we'll see that by the end of the year, which means your 5-year rate could go down in the second half of the year. So that's basically what we see. All rates going down and possibly more than expected.
Warren, you've talked about the possibility of the Bank of Canada having this year maybe doing a sort of a two-tiered phasing of rate cuts. What do you mean by that?
Well, so look, let's just be clear here. We have and the bank has been operating with the base case forecast. And I think what we're trying to assess is how much at risk that forecast is. And much is to be learned. There's a lot of false precision in terms of GDP impacts and then the pass-through, to inflation from tariffs and the monetary policy reaction function. Let's keep it a bit more simple. Let's just say in a trade war, a tariff scenario, Canada suffers more than most advanced countries, and certainly suffers more than the United States. And that's going to argue for lower interest rates. Now, what the Bank of Canada is also saying is that, look, a tariff fight, and if we're retaliating with tariffs, that would create some inflation. They, of course, will want to monitor that. And I think, to be clear, the bank's got, and Ed pointed out, they've got an inflation mandate, right? So you can't be dismissive entirely of the inflation risks born of a tariff fight. But look, economy, you destroy more economic activity in Canada in a trade war, you got to be going lower. And I think the question is the speed, the magnitude, and ultimately the destination. We should probably be debating what's the right first digit. Is it a one handle? Probably in a tariff fight. We're at 3% today. I think what we probably are all agreeing is that the bank's not done here, given the balance of risk. And I think there would have been a good argument for more interest rate cuts, even if the base case forecast was somehow possible. And that would, of course, require, President Trump to not apply tariffs.
Ed, do you see the Bank of Canada key rate below 2% later on this year, potentially?
I'd say north of 50% chance of that, yes.
Really?
So my base case, if you want to center my forecast, I say 2. And I think his skew is more to the down than the up. So we can have a one handle on the overnight rate easily. And I think you do that, to Warren's point, even without trade war. I mean, I think that, we, as our firm, fundamentally disagree with the Bank of Canada's assessment of the neutral rate. We think it's lower. So if you think the neutral rate is closer to 2, which is our view, then that doesn't even get you easing. That just gets you a steady state. You got to go below that to actually try to stimulate the economy. And if some of these downside risks, manifest themselves, yeah, you've definitely got a one handle. And I think, like I said in the last hour, I give kudos to the Bank of Canada for A, hiking rates aggressively when they had to, when inflation was spiking, and B, being very aggressive in cutting them. And I would encourage them to continue to do so, because you want to get ahead of that curve. You don't want to end up somewhere closer to 0. So the faster you get it down, the more you can avoid that outcome of having 0 interest rates in with a country with a massive debt stock. By the way, I'd say the same thing for the G7. It's not Canada specific.
I think the one thing we learned, if I could just jump in on this, follow up on a point that I just made here. I think not that we needed reminding, but we saw on the way up and now on the way down on interest rates. I mean, we've got not a high performing, but a highly tuned economy here in Canada. And I mean highly tuned to interest rates. So when the bank is moving aggressively on the way up, you end up not surprisingly, slowing down a lot of that interest-sensitive demand, particularly in the housing market. We had been, having rushed in this now 200 basis points, we had been potentially in a scenario where you might have seen a little bit of firming as those interest rate cuts kind of worked their way through the system. Now, of course, the worry is that we risk running into the proverbial brick wall of a tariff from our largest trading partner that no amount of cuts really, I think, saves the Canadian economy. I think that's one of the key takeaways and probably the appropriate risk assessment at this juncture.
Earl, it's difficult to gauge, but can we look back to the Trump 1.0, the first administration, and tariffs then, and what transpired then, and what Canada did? Is there too much hand-wringing, too much consternation? Will cooler heads prevail at some point? It's hard to forecast, though, I know.
Yeah, you know what? I don't even think we have to look at there in regards to anticipate future interest rates and direction here. And the reason why I think the main thing, and we haven't spoken about this that much over the segment, is the currency. I think a lot of what we're saying bodes for a weaker currency. And I think that's the mechanism by which equalizes activity here in Canada, at least on a medium-term basis. So I think that's an important factor, and I think, it bodes for a weaker currency, everything that you've heard here at this table today.
So good for exporters then? Yeah? Yep.
Well, I guess, if just coming back to the 2018 exercise, I would caution viewers not to be too comforted by the 2018 experience. What did we see back in 2018? We had steel and aluminum tariffs with Canadian retaliation, narrowly based and not that long lasting. We, of course, were trying to renegotiate NAFTA, which became USMCA or CUSMA, whichever you prefer, during that period. So very uncertain period. Temperature got turned up. It was uncomfortable days. The economy actually held up reasonably well in 2018. What we're talking about and trying to model here is something much more sinister, more serious, more longer lasting. And as a result, the destruction risks being much more significant than 2018. So some false comfort, in my opinion. But Earl is rightly pointing out, look, you do have some rebalancing mechanisms, and a cheaper currency and lower interest rates and fiscal supports are presumably the natural trifecta that you typically would expect to see.
Ed, what's the worst case scenario? What's the best that we can handle?
Well, the best would be that, we can come up with a deal where we, give 2% of our, commit to 2% of GDP to NATO defense. We harden up the border a little bit, all pretty commonsensical things anyway, and it goes away. So that's your best case scenario.
Okay.
Your worst case scenario is it's full on 25% across the board, effective February 1st. Tit for tat retaliations here. I think our policymakers are nuts when they say dollar for dollar, because they're 10 times bigger. That's like dollar for, it should be $1.10. You know what I mean? Like it's got the wrong ratio off. Yeah. And let's just be clear. Trump signed the USMCA. We have a deal. This is called blackmail. This is not a strategy, it's blackmail. And I personally believe Michael Corleone had it right in The Godfather 2 when he was being blackmailed. I'll give you my offer. Nothing. You get nothing. And that should be our response.
All right.
I think the one last thing, the worst case scenario is not just Canada-U.S., right? And we sort of hinted at this. It's global trade war with full retaliation. That's the real worst case.
It is. It's back to the 30s. And then that is just terrible for global growth and inflation, and it's just awful.
Gentlemen, thank you all for your insight today and great information. We really appreciate it.